Today we're going to demystify and debunk some of the complexity around capital raising and employee equity. Raising is a very time-consuming process. You've got investor meetings, you've got to build a data room, you've got to do all your legal preparation, pitching, getting all the documentation prepared and signed, and then there's always things that go wrong along the way. I've run quite a few rounds myself, and every round's different, and something different always goes wrong every time. So there's a lot to do. We want to speed this up for you, minimize errors, help you to have more time working on your team and your product, customers, revenue, all that sort of stuff. So we have an awesome panel of experts gathered for you today with legal, compliance, founder and investor backgrounds, heaps of experience. We've really been enjoying meeting the panelists this year. So our goal today is to speed up your round, make your cap table more awesome, get more value from your equity. We will be recording this, as a lot of people want to watch this in their own time, but being live is better because you get to ask questions directly to us and we can help you with whatever you need. So make sure you pop your questions in the chat or the Q&A. We'll definitely answer every question we can. It's a big benefit of being here live. So make sure you take us up on that. And so to warm us up on using the chat, please add in where you're from, what stage you're at. Are you bootstrapping, pre-seed, Series A? Pop all that in the chat and pop in where you're from as well. Anyone not in the US? Anyone have team members or investors not in the US? The startup space is globalizing more and more all the time. Today, I'm in Denver. Last week, I was in LA. I think Melody's in Chicago. Cash, Boulder. John's Denver, I think, as well. So, awesome to have you here. So let's get into it. So today we have an amazing panel. My name's Jason. I'm co-founder of Cake Equity. Our mission is to help founders, startups, and their teams to create value from their equity. We want to minimize the complexity, maximize the ownership culture, the engagement and alignment between the founders, the company, their teams, to build amazing companies that can build a better future for all of us. We have over 3,000 companies using Cake in 79 countries. We're super focused on the US right now, specifically Colorado and LA. So please hit me up to chat anytime. We also have the amazing Melody from Maya Law, Cash from Sweater Ventures, and John from Stout Street. So thank you all very much for joining. Would you all please say hi and tell the audience about yourself, your company and mission, and especially in relation to today's topic. Maybe we'll start with you, Melody. Welcome.
Hi, thanks for having me. My name's Melody. I'm a senior attorney with Meyer Law. We are an award-winning, women-owned law firm that essentially specializes in helping companies, really from startups to large corporations, with the legal framework. So what I mean by that is anything related to contracts, to corporate employment, hiring, protection of IP, fundraising, investment, and privacy-related matters. Our team has really helped thousands of companies, and we mentor at incubators and accelerators across the US, like 1871, WeWork Labs, and Techstars. And happy to be here.
Amazing to have you here. Sorry, and how about yourself, Cash?
Hey everyone, I'm with Sweater Ventures. We're a venture fund based in Boulder. What's unique about us is that anyone who downloads the Sweater app from the App Store could actually invest money into our fund. All that we require is that you have a US Social Security number. There's no accreditation requirements. And we have been able to build this fund with thousands of investors from across the country that we can then go to support our early stage investments. Currently, we have 70,000 people in our community, between 6,000 and 7,000 investors, and we invest in primarily seed and Series A companies that benefit everyday people either at work or at home.
Wow, that's cool. That's so cool. I'm still an Aussie, but apparently I can get my social security card once I get my E3 visa. So I better get that done so I can get into your fund. It's cool. And what a community, 70,000. Wow, congrats. John, look, been great getting to meet yourself as well and your team over the last couple of months, and welcome. Yeah, let everybody know a bit about yourself and Stout Street, please, mate.
Sure. So Stout Street is an early stage fund. I'm one of the partners at Stout Street. We invest in pre-seed and seed stage companies, primarily in the middle of the country. Between Fund 1 and Fund 2, we have about 70 portfolio companies. We are deploying capital out of Fund 3, which is our brand new fund. Our fund thesis is to invest in companies that improve efficiency in existing markets. So we kind of specialize in red ocean markets. We're primarily looking at companies that add value, and that value can be quantified in a certain way. And that value is net positive when it comes to the price for those services or products that companies are selling to their end customers. In terms of our focus, we're looking at companies that have a little bit of traction, companies that are doing at least 15,000 in monthly revenue is where we start looking at companies. But in terms of our experience working with early stage companies, we see about 4,000 to 5,000 companies every year, and we also are organizers of the Unmet Conference, and we host those conferences in 6 different states all across the country, including Colorado, Arizona, Utah, Ohio, and right now we are thinking of launching one in Washington State as well. So yeah, hit me up. I'll put my LinkedIn on the chat. Feel free to reach out. Happy to answer any questions. And thanks for having me on this panel, Jason, and also me with this wonderful panel.
Yeah, amazing, wonderful, so good to have you here. That red ocean strategy is super interesting. Don't often hear that. And then also, the Unmet Conference is just such a wonderful program, and Kate's excited to be getting involved in that as much as we possibly can. It just looks so cool. So congrats on that. So in the chat so far, we've got Rachel from Portland, Oregon, done seed round. Oh, from Launch. Okay, cool. Yeah, Kate's just partnered with Launch, and Jason Calacanis is our lead investor. So good to be in cahoots there. We've got Calgary. I think that's Canada. I hope that's Canada. Please excuse me with my North American geography. So bootstrapping, we've got Chicago, post-seed, we've got Series B. So look, I guess the most important thing to take out of this is, we're here to help you. We've got some information to get through. It's really cool, but please do ask your questions so that you get as much value out of this as possible. We've got some specific time at the end to go through the questions. So, all right. So the first thing we're going to run into is how to set up your startup before you raise. So how to prepare to raise. Capital raising is, it's a 3 to 6 month process. It does take quite a bit of time from start to finish. This year is a more difficult year than it has been. No matter what round you're doing, the preparation stage, in my opinion, is the most important stage. So, as I say, we are going through a hard year for funding. Last year was a record year. There's a lot of information out there around, I guess, the complexities of this year. I don't know how much we'll dig into that specifically today, but I think the most important point to make here is that startups with traction, revenue and growth and a path to profitability are getting funded. Cake is sponsoring the Launch Founder University, which is for a very early stage, but Jason Calacanis said on that, assume no funding this year, and if you get funding, it's a bonus. And I think that's just the right mindset to have in 2022, 2023 until things change. Investment is more towards 2020 levels, so definitely investment still happening, but it just can't be expected, or it's not as easy as it was last year. Startups with no clear path to break even are struggling most. So day one startups with higher costs than they can support, with their revenue and cash flow, are finding it more difficult. So definitely try and sort those things out. But today we're mainly here to cover the processes to get you funded. But if anyone needs specific insights on the challenging market in 2022, 23, please do pop that in the chat. So, all right, so let's start with the very early stage considerations. We'll just do this quite quickly. From day one, for those really early stage idea stage founders out there, how should a startup be set up, ready for, say, their pre-seed or friends and family round? Melody, what would you say there?
I would say, I mean, obviously, that's one of the most important decisions the founder is initially going to make at the outset, is deciding what type of entity to form. I think maybe an overview of all the various entity types is probably beyond the scope of this discussion, but any founder who wants traditional venture-backed startup typically will form a C corporation, or if they start as an LLC, it'll eventually transition into a C corporation. And ultimately, what that comes down to is most investors do not want the tax liability that comes with pass-through tax entities like LLCs, partnerships, S corporations. And so investors and essentially outside board members want the comfort, of well-established C Corp. They're not going to have to report profits and losses. The only time they're reporting on their own personal tax returns is if there's going to be a distribution. And so it's pretty common to be set up from a C corporation from that perspective. With that being said, does that prevent you from raising a pre-seed round, especially when the first checks are coming from friends and family and angel investors if you're an LLC? Absolutely not. We have and represent a ton of startups that are LLCs and raise the pre-seed round that way. It's just that, again, when you get to that VC level, you typically will transition to a C Corp at that point. And so just generally speaking, at least from a legal perspective and at the formation, usually if you're setting up a corporation, you'll have the formation documents, your initial certificate of incorporation, documenting, setting up the board, additional consents approving just the basic organizational matters, adoption of your bylaws. One key thing that you as a founder should make sure that you do at this outset is actually transfer your initial IP that you might have created prior to forming the company into the company. The company moving forward should be the owner of any IP that's created. And then, of course, at the outset, you'll establish the founder's initial equity stake in the company, including, I know we'll get into this probably a little bit later, but vesting details, making sure that you're filing any 83B elections that you need to, and then just be cognizant of how you're splitting that equity amongst the founding team at the outset, because changing an equity mix down the line can potentially cause some adverse tax implications if you try to rebalance that cap table later.
Very cool. A couple of things we'll definitely dig into. I remember right at the beginning when Cake started, we were setting up the company after we sort of, hang on a sec, this Cake thing's pretty cool. Let's do a bit more of that. And we had to go get our domain, make sure it was in the right entity and all those sort of funny things that you don't often think about. So, really, really like how you brought up that IP point, and investors are really onto that when they're looking at you early, because it's a really common mistake, isn't it, for that sort of day one up to pre-seed seed. So, hey, John, just quickly on that, from your perspective, I know you're coming at it from a VC perspective, but what I thought was interesting about what Melody said as well was like, you can do sort of the friends and family in an LLC, but certainly by the time you're getting venture, you want to have a C Corp. But there might be this in-between period where you might be going to an angel group or going to an accelerator. Do you have insights into that sort of accelerator angel group stage, and whether you should be a C Corp at that stage, or whether you can maybe hack through that as an LLC? Any experience or insights on that?
Yeah, I would say if you're building a company that is ultimately seeking venture capital or angel or accelerator capital, I would suggest a C Corp, primarily because as Melody said, you can start with an LLC, but the cost of moving from an LLC to a C Corp could be quite expensive. And also it's you're providing another reason for investors to say no, right? And especially for funds, many funds structured.
You definitely want as few reasons for investors to say no as possible. Yeah, I totally take your point. And like, some people might be trying to save that little bit of cost of doing the C Corp, but then, as you say, like flipping from an LLC to a C Corp after you've already got some investors in is probably going to be much more costly. So get that done super early. I've just got one more quick question on this foundation stage. I think most of our listeners are probably, a little bit further along. And I might flick this back to Melody, just on vesting. So, my position on vesting is that founders should have vesting. If there's more than one founder, it's really important to have a vesting schedule in place. It sort of protects both founders in case something goes wrong, and things do go wrong, especially if you just met them, and quite often you haven't known them for a long time when you get into business together. Melody, would you like to just talk a little bit about the mechanism for putting a vesting schedule in place and the key things that people should think about?
Yeah, absolutely. I think especially if you have not worked with your co-founder, definitely putting a vesting schedule in place for you and your co-founder makes the most sense. And for those of you that may not know, vesting essentially means as of day one, you essentially don't get all of the equity. You work over a period of time to earn it. A traditional tech startup would be set up with a 1-year cliff over 4 years. So what does that even mean? It means for the first year, no equity actually vests, and then a portion vests after the first year, and then maybe monthly thereafter over the 4-year period. Sometimes shorter vesting schedules for founders could potentially raise eyebrows. Ultimately though, we've had situations where founders put themselves on vesting schedules. By the time they go into their seed round or Series A, they're fully vested. What happens is investors still want to make sure that you're committed to your venture for the long haul. So you might have to re-up your equity for additional vesting considerations. So even if you put yourself on an initial vesting period, don't be surprised that you might have to put yourself on further restrictions during additional funding rounds. It's just to make sure, from an investor's perspective, they want to make sure that you are in it for the long haul. They're investing in you as much as they're investing in your company. So, but for purposes of co-founder protection, absolutely. I think, Jason, you hit it. And it's that you never know what's going to happen 3 months from now. Somebody might need to get a full-time job. And so having the vesting schedule not only protects you, but also the company from ensuring that you're not giving away equity and having those restrictions in place, and potentially the company having rights of first refusal to reclaim any equity that's potentially vested at that point if you're not staying with the company. You don't want to be in a situation where you have a co-founder who owns 50% of the company, no longer part of the company.
Exactly. That's the key. Founders have to be fully committed, 150%, all in to have that big piece of equity. And if that stops at any point, then all that bit of equity that's got to be earned needs to come back to the company. And normally that can be bought back for like $1 or whatever. So look, really important mechanism. It feels bad as a founder. I really hated it. I'm in business for myself. I run my own company, you go into business like this and you're like, hang on a sec, I have to vest my own equity. And then as you say, I have to revest it again sometimes, depending on the terms that you get on your round. But I think it's actually a really fair mechanism in hindsight. And having been through the process a couple of times, it balances the commitment and the risk of the founders with the commitment and the risk of the investors. And it's a really, really important mechanism for aligning the all the stakeholders. So anyway, all right, very good. Thanks. We've done the day one stuff. We'll move on a little bit now. So your founders have got through, the companies have got through, they've got some traction, they've got some revenue. They're up to their seed or their Series A. Things do change at that time. So you've learned all this stuff about capital raising, and then your next rounds are all totally different, which is part of the awesomeness of being a founder. What should startups think about when it comes to their legals leading into, say, a seed or a Series A? Melody, what do you think actually, I've been hitting you up quite a bit. I might give you a little break. Cash, you see a lot of deals coming through. Founders are quite often a little bit unprepared when it comes into rounds, and I'm not hassling founders. It's just so much to do. What are some of the things that you normally see coming into a seed or a Series A, around the legals and the cap table that we can maybe help founders with today?
Yeah, I'll say one thing just about the step before that could give some context to. As a seed investor, there are lots of pre-seed stage companies that haven't quite committed fully to the venture track yet. You can still raise some money from angels on a convertible note or other things and not fully commit to the venture track. But by the time you hit the seed round, it's truly a strategy of go big or go home when you start taking institutional money for many funds. I know that there are funds out there that have different theses, and that changes how you think about your equity quite a bit. So I'm actually okay with pre-seed or earlier stage companies doing LLCs. I know we talked about that simply because they're a simple structure. If you don't know yet if you are fit for the traditional VC swings and you want to have some flexibility, but by the time you get here, let's say that you're committed. And I think that in a legal standpoint, it's very important to not just have the legal and cap table clean, but to be able to speak to the strategy as to why you did it that way, why you split your equity the way you did, and have those answers readily available. Because as the investor, I want to make sure that I can get inside your head and understand your strategy and know that there is a strategy and that there were conversations and thought behind those things, because those are the red flags for me more so than, you know, the bare minimum of having all the legal docs in place. So.
No, I love that. I remember us at Cake having this session like back in the day. We're all looking at each other and we're like, this is going to be big. Like, is everybody ready for this like for the next 10 years? Because there's no off path. And so I think that, you know, making that decision as a company is critical, and then that can determine, you know, some of these legal steps that you take. So Melody, anything from yourself? So we talked a bit about that day one and setting up the company and you know, the pre-seed friends and family round. I mean, anything that you would say on the legal and cap table side of things that people should think about differently, or that you see differently from a legal?
Yeah, I think traditionally startups think about equity definitely in a different manner than once they get funding, in my opinion. I mean, as a startup, you might lack capital to pay market salary rates to in-demand, you know, service providers. And then the single most valuable thing that you have to offer is the upside associated with some like sweat equity it awards to your service providers or employees, whether that be via stock options or restricted stock awards. But ultimately, not getting a proper equity incentive plan or option pool and failing to grant equity awards early could potentially mean that those valuable early employees, advisors, consultants really lose out on the benefit of the lower price. And so I'm not one of those folks that think you need an equity plan as of day one. Obviously, there's a lot that happens between day one and maybe your first hire. And so, but definitely once you bring on or are thinking about bringing on that first service provider and granting equity, you know, you want to think through, okay, market salary rates to keep this person, to retain them, but also keeping in mind that every round of funding, you're going to go through dilution. You're going to need to increase your equity pool for service providers along the way. And so you might often end up giving away more equity in the beginning than what you might want to. And so thinking through those factors and the potential future of what you need to do is really important, I think, from at least a cap table perspective. I think the last thing you or your investors or future investors want to see is a cap table that is riddled with you know, service providers not subject to standard vesting terms, or worse, no vesting at all in some scenarios, or no repurchase rights, or no, you know, some things that like just stick out, I think. So thinking through that in the beginning, I just think is really important.
Yeah, love that. Great insights. And so from John, I'll definitely come to you in a sec. I just wanted to talk about, well, I want us to talk a little bit about term sheets. So the first time I saw a term sheet was for the seed round. I think sometimes you get through the first little bit, you don't necessarily have a more traditional and professional term sheet around your notes and safes and stuff in the beginning. And then, you know, you see this term sheet, and I've been in finance for 20 years, and it took me a bit of time to chew through that bad boy the first time I saw it. John, I mean, you had something to add, so please feel free to add that. But I would like to talk a little bit through some of the key elements of the term sheet that people might not be familiar with, or even if you have been through it before. Each time I run around, actually, I learn about a different element of the term sheet and its importance. And so perhaps we could highlight some of the more important elements of the term sheet and how we see them. And then if you can, while we're doing this, talk a little bit about, are you seeing changes in these terms between 2021 and 2022? So for example, you know, last year, capital raising seemed to be incredibly easy. And I heard this week that people are now paying to pitch, which just seems like insanity to me. Please don't pay to pitch, by the way, but I guess it shows that there's been a shift in the market. And so perhaps we can talk a little bit if we're actually seeing shifts in the market and what people should be aware of, or perhaps even avoid around term sheets. So that was a really long question, but let's do that a little bit because I think it's important.
Yeah, I'm happy to talk about term sheets. Just one thing to add on the structure side. Doug Mandic was we just had this chat. We talked about IRC 1202, which is the tax consequences of like the differences between LLC and C Corp is it does help your investors and also help you on the capital gains taxes because you're starting a company obviously to either sell or have some sort of liquidation event. So again, being mindful of how those things will be taxed for your investors and for yourself is important, and that's another consideration to consider while you're deciding whether you want to do an LLC or a C Corp, especially if you're raising money from outsiders, even if it is a convertible note. You want to make sure that you do have a like IRC 1202 filed and you're sharing that with your investors as well so they can qualify for that exemption.
Yeah, nothing worse than having a big win and then paying double the tax you need to pay or whatever. Like that would be one of the worst lessons to learn, wouldn't it?
Yeah, I know we came pretty close to losing that exemption of the recent Congress, but I think we kind of narrowly escaped it. But anyway,
Right.
going back to the term sheets, to your question, some of the changes that we're seeing is more prominent in the later stages. I would say A and B. In some of the larger shifts that we're seeing in the market, or the big impacts that we're seeing in the market from a venture scale, has been more on the later stages. Obviously, growth, B and C stage companies have been hit the hardest in terms of valuations, in terms of changes in their term sheet, getting more aggressive and master-friendly terms. So some of the things that we are seeing is a pretty high preference stack. We're seeing higher liquidation preferences. We're seeing tier liquidation preferences. We're seeing ratchet provisions, which we haven't seen for a few years.
Wow, yeah. People were saying 1 or 2 years ago, they were like, oh, we'll never see those things again. But anyway.
So yeah, like MFN. So again, with the earlier stage companies, the biggest hurdle that we're seeing, or the biggest hurdle for investors, is they don't know how to price this market. So there's a lot of pricing confusion. So you're seeing a lot more uncapped bridge rounds, which is an easier way for investors to say like, hey, I'll pump this to the next investor until they figure out what the pricing or the valuation for this company is. And also in a way you're not, even if there is a possibility of a down round, having an uncapped bridge round allows you the ability to keep the company afloat and keep the company running until the next round. So we're seeing a lot more bridge rounds and C plus and Series A plus rounds where there's a lot of bridge financing.
Kate knows all about that. We just did an up bridge as well. I think everyone's doing it. Yeah. Cash, what are you seeing? Anything on term sheets? Like the liquidation preferences, obviously something to keep an eye on. I think valuation is really interesting as well, because I think sometimes pre-seed and seed is easier because it's kind of like, how much money do you need? Roughly, where are you? Okay, we can sort of invest in that, and then sort of between sort of like that first seed round and sort of Series B is where the most difficulty is in valuation potentially. I don't know how you guys see it, but like the very, very first round is the easiest one because it's like, okay, it's $1 million and it's 15-20%, whatever, okay, or 10%, whatever, okay, let's get through this kind of thing. Let's fund this company. So yeah, Cash, what would you say on, I guess, this whole term sheet valuation in 2022 climate?
Yeah, I've also seen a lot of safes and convertible notes between rounds, and I've seen them used more often in later rounds than than when they originally built for the very early stages of a company. We've seen and actually invested in Series A plus on a SAFE, but they're in market in a few months for their Series B. So they're really at a Series B milestone wise and revenue wise, but we still invested on a SAFE. And I think that that's interesting for a few reasons. One is the founders are being sensitive to take money while people are willing to put money in. And it's easier to take that money as people make commitments on a SAFE than maybe a priced round where you have to get all the stars to align all at once. And and I've seen these SAFEs used different ways. I've seen them uncapped, but I've also seen them capped, and they're just treating them as if the cap is the valuation to make investors comfortable with investing at whatever milestones they're at that day. Some challenges I've seen and mistakes that I've seen made in this last year is some entrepreneurs raising on a SAFE last year at one term and then raising this year on a SAFE at different terms and not going back and cleaning that up moving forward. So that can create problems. One, your investors can get unhappy with you and each other if they're given different terms within a fairly close time frame. And two, it raises questions down the line like, oh, did you just have a hard time raising, so you had to reduce the price and you didn't bring other people in? Are you going to treat me poorly? And so I think you have to be thoughtful if you are doing a bridge round between this to make sure that you're treating all of your investors fairly and transparently through that process.
Yeah, let's just dig into that briefly, because I saw that come up a bit publicly during the week last week. You know, someone had raised, I think they were raising kind of one SAFE round and they were doing different terms for different people, which obviously, you know, you're going to upset your investors if you go ahead and do that. I mean, sometimes you got to do what you got to do as a founder because you need the money, but that's going to cause you problems, and you really need to manage that as best you can. And my view would be is you keep the SAFE terms as consistent as possible, if not totally consistent across a round, because that's sort of the fair and right thing to do, and you're building a good investor brand doing that. How far apart can the rounds be? Is it that like, okay, we did a round at a cap of 25 mil and now doing a round at a cap of 18 mil or whatever, and they're only like 6 months apart? Are you supposed to somehow normalize the prior round? I mean, what's the right hygiene there?
So just to incorporate someone's comment here in my answer, I also see that uncapped notes are fairly unsafe for investors, so that they will avoid them. You will reduce the number of investors that are attracted in that. Now, as far as like how I tend to think about different terms, if everyone knows and is okay going into it, that's problem number one that you have to avoid, right? So I've seen some people will tranche. This is becoming more common. I don't know if I would do this as an entrepreneur, but I've seen in Colorado a few times now. They'll say they'll raise a seed round on a SAFE, and they'll take the first third of the round at this term, and the next third at a cap 1 million higher, and the next third at 1 million higher. And they're trying to do that to incentivize to make decisions faster and to come in and reward their early investors. It does create a little bit of complexity, but I've seen that as kind of a strategy to create urgency in a round. But if it's going the other direction, my opinion is that it really stinks as an entrepreneur to have your shareholders not happy with you and not willing to help you out when things get tough. So it's worth going back to them, having the conversation, and either bringing them into the same terms or at least getting some sign off or something before moving forward.
100%. Stakeholder management, one of the key jobs of a founder, and you got to keep your investors on side is absolutely critical. So great advice there, and specific to the market and one of the bigger issues that people are probably having right now. So great stuff. Melody, just to round this out from a legal perspective, anything particularly you wanted to add around these terms, things people should be really aware of, or what sort of red flags or risks could we perhaps be avoiding this year around capital raising or terms?
I think, trying to deviate too much from the quote unquote market standard terms for no reason can send a bad message to your investors. I mean,
I love that standardization. Woo, that's perfect.
I've had some clients, try to get creative during the rounds because of various situations, and it ends up just creating more complication than really what it's worth at the end of the day. So keep that in mind. On the flip side, I think it's a giant red flag to founders if a prospective investor is asking for way off market terms as well, particularly those that create some type of overly burdensome obligation on the company, or they try to complicate the financing process. You know, I'm experiencing that right now with one of my clients. So, you know, just generally speaking, you have to take into account the market conditions that we're in. But if somebody's overly complicating anything on either side, you know, to me, that's a red flag.
I love that. On the founder side, you know, there's lots of mistakes you can make because you're inexperienced, but on the investor side as well, there's mistakes you can make by perhaps being a bit tricky or a bit greedy or a bit risk averse in a year like this. And then you get into 2023, 2024, conditions are good again, and you've got a cap table with all these crooked terms in them, and it's harder to get funding down the line as well. So I think we need to be pretty cool about where we're at and keep these cap tables and these deals nice and clean and standard, obviously being aware of the risk as well. I'm not saying that we shouldn't be aware of the risk and balancing that out, but that's awesome insight. Thank you very much, team. All right, so moving along, we're just going to do a really quick bit on how to find investors and pitching. From my side of things, you know, I'd say pitch to your superpower. And I guess this is a little bit more for your early stage founders. I think once you get further down the track, you're probably really good at pitching. You know what your superpower is. If you're getting venture funding, you know, you've got your growth, you've got your market, but you know, early on, and perhaps it's a reminder for everyone, you got to be able to pitch with passion and power. You got to make investors feel like you can change the world in some way, you know, or you're really going to struggle. Not only for investors, but hiring is harder. Everything is harder. So, you know, make sure you understand where your superpower is and get some coaching and get feedback as necessary to make sure that your pitch is hitting the mark. I think every time you go to market to raise capital, you can always be pitching stronger or clearer, getting your message tighter and tighter. So, you know, really spend the time on that. And then my only other point on this is to just be aware in 2022 that pitches require more financial stability than what was the case before. I think this is quite obvious, but just have to make sure that we articulate this today. So you need to have more conservative financial strategy. You need to be more efficient with use of funds. You need to be able to show break even. This will likely change back again at some point in 2023, 2024, when we've got, you know, risk on again and people are fired up for the next big growth cycle. But just this year and next year, I'll be really making sure that you're aware of that. Now, just so we have time for a couple of other points. Anyone want to add anything about where to find good investors? Obviously 2021, early 22, it was just like, it was investors everywhere and you know, there was funding everywhere and that really wasn't a problem. Any insights this year that we can help people with about how to find investors, how to pitch better? Kind of an open one. Anyone want to put their hand up for that one?
I mean, from my perspective, I would start with my initial network, ask for introductions, see who's connected to which individuals. From our perspective, when clients come to us, we have our own network of investors. We represent a couple funds and some angel groups, and we have a group that if somebody wants to pass through their exec summary, then we send it to our network. So we're happy to help from that perspective. And then when you meet with investors, for me, ask for additional intros. I mean, that's how I feel like most startups will fill out their round. They'll get their lead, and then their lead will introduce them to someone. That person might introduce them. I mean, from my perspective, it all comes down to networking and building that out, and to start earlier than what you think. You know, start having initial conversations with folks even before you need investment, so that you can get advice and start building those relationships and stay at the forefront.
Only thing I would add is an overlooked source of introductions to VCs are your peers, other entrepreneurs. Any entrepreneur who's closed a seed or Series A round pitched 10 times the number of investors that they actually raised money from, and they likely still have those lists. And it's a great way to both become aware of more funds that you maybe overlooked, or get intel on which funds play in which spaces. Because I think the hardest part to do from the outset is to know if you fit into the general thesis of a particular fund simply by looking at a website or something like that.
Yeah, I love that. I think, you know, I always advocate having somewhere near 75 investors in your CRM when you start, and those investors have to be aware of you, they have to invest in your niche, they have to invest in your stage. It's amazing sometimes when you go through and if you start raising and you've only got like 10 or 5, then you got to build it while you're raising, which just flips the whole raise upside down. If you can have your CRM full and have done the homework in advance when you start your round, it's much easier to work through that way. It creates more dynamism and energy in your round, and you move through it a lot more quickly. So I think we've got a little bit of time, so we're going to cover now how to use your equity, your employee equity as a startup as well. It's a critical component of startup life, and as a startup and a founder, quite often you've got 10 to 20% of your company out there with your team, and so this is an incredibly material amount of money. Right from day one, it could be 500 grand or $1 million, and then as you go through the rounds, you've literally got millions of dollars worth of your company equity out there, in your team's hands, and we have to work out how to, get value from that. So again, let's sort of follow the same process we did last time. So from day one, I'm sort of a day oneer, but I think I take your point, Melody. I'm not saying like, okay, you start up your C Corp and then you immediately go get your, you start up your equity plan. I think that's probably a little bit hectic, but I agree. Like as soon as you want to hire, as soon as you have advisors, I really love seeing advisors having a bit of equity. Like it really puts some skin in the game, and professionalizes that relationship, and it builds trust. You don't want to have too many handshake agreements, because those relationships are less likely to be meaningful and continue on. So, I would suggest, right around when you're starting to build your team is the perfect time to get the very first equity plan in place. Normally it's around 10%. So as I said, $5 million pre-seed company, 500K worth of equity that you're utilizing, at that time. So it's pretty serious stuff, and you want to make sure you get it right. So John, I might flick over to yourself. I don't know how many, day one companies you see these days, but, how would you sort of see just in that pre-seed, seed stage, what advice would you give to people about tackling that in the right way?
Yeah, in terms of, I see a couple of questions on equity incentive options for advisors, for team members. So there are multiple ways to look at it. Obviously, for team members, it depends on what value or what skill set they're bringing and what level they are, right? So if they're co-founders, obviously you're giving them a little more equity. And going back to the vesting schedule, like having a clear vesting schedule for your leadership team allows you for a little more stability in your team. And also it is a way to make sure your early talent stays with you until your growth goals, or at least your early stage goals, are achieved. And the incentive plan, obviously the percentages of it are different for different industries. I feel like it's hard to generalize how much do you pay for an advisor, or how much do you pay for like your first 10 team members versus your first 50. So it's a fairly large, wide range. And it's hard to quantify, unfortunately. But what we've seen is pre-seed and seed stage companies allocating anywhere between 10 to 15%. On the equity option side is fairly common, especially when they're looking to raise capital from angels and early institutions. That's fairly common. And that pool can get refreshed over a period of time as you go raise more money. So it's not the only pool that you have access to. I'm talking about general things that let the other panelists talk about.
Yeah, there's a couple of things to dig into there, absolutely. So maybe we'll go dig into the legals a little bit with Melody. So, you've got to set up the scheme, you've got to put it in place, you've got to have offer letters. I mean, what would you sort of, how would you, I guess, explain that in a succinct way for people, on the legal side of things? What are the risks? How do we get it done in the best possible way?
I mean, depending on what stage you're in, there's different types of equity awards that you might want to tie to your equity incentive plan. Earlier stage, you might be thinking of RSAs, which are restricted stock awards, which are beneficial to your employees because they're paying very little nominal value for those shares up front. as your company starts to establish some type of value, stock options are typically the way to go. Your governing document will be the stock option plan. Each individual employee would receive then an award agreement and then potentially an exercise agreement so that they can exercise those stock options at that point in time. Where I see startups in general, except when we have to go through due diligence for a client that is seeking funding, is that they never have the proper authorizations in place. Your board and your stockholders have to approve the plan. Depending on your voting thresholds and levels, your board should always be authorizing and approving every equity award. That's something obviously internal. If you're your only board member, still got to document it. I know it sounds silly to have a meeting with yourself, but it's still something that has to get done from a corporate perspective. And then also just making sure that you're complying with federal, state securities laws, because you're dealing with securities with equity, and it still comes into play with your equity incentive plan. And then kind of going back to, I think, one of the questions with respect to how much equity to give, I think there was a question with respect to advisors and things. Everybody's going to be a little bit different, and it's going to be dependent on the level of involvement. But most of the time, advisors are providing very little. They're not time intensive relationships. And so you're looking to give, as low as 0.1% to 0.25%, definitely under 1%. Again, but depending on the level of involvement that they'll be in. I think there was another question in relation to what you're asking the advisor to do. It could be a number of things, and it's going to be dependent on the advisor and what they can provide to you, but maybe attending meetings, providing strategic advice, asking for introductions. If you have a strategic project that they have a skill set in, you might want their involvement in that project. So again, you have to kind of look at the threshold and what involvement you'd want, and then apportion the equity grant in relation to that involvement.
Great. Yeah, a few things to dig into there. So you mentioned RSAs and stock options. Can you do both of those with an LLC, or do you need a C Corp for those? How do those work in relation to that earlier LLC versus C Corp question that we were covering?
Yeah, so LLCs are a little bit different structure. You have capital interests and profit interests. And so a lot of times I'll get clients who are LLCs and they say, well, I want to do a stock option. Well, we can mimic a stock option, but the whole benefit of a stock option is the tax benefits that are afforded to your employees. And unfortunately, with an LLC, you don't get those tax benefits. And so that's why, yeah. So you can definitely
reason to have a C Corp.
Yeah, you could definitely do equity grants with an LLC and structure them to mimic similar ways. It's just that the tax treatment is completely different. If you have an employee that then you're granting equity to in an LLC, guess what? Now they have to receive a K-1. They're a member to the company. It complicates things if they're also receiving a W-2 salary because they're now a partner in the company. So the tax treatment is probably the biggest difference between the types of entities and considerations that you'd have to take into account.
Awesome. Yeah, on the advisor thing as well, I think it's important to highlight to people that the Founder Institute have got a really good agreement for this. It's called the Founder Institute FAST, FAST. If you just Google it, it's an actual standardized agreement for advisory services in return for stock options, and have this nice little table at the bottom that sort of says how much impact is the founder having and how early is the company, and it sort of tells you how much equity that the founder would receive over a 2-year period, and it's kind of 0.1% to 2% depending on how strategic and how much value they're adding and what stage you're at. And I think it's a really wonderful and simple way to work with advisors. Some will say, look, I'm adding more value, but at least you can say, okay, great, let's document that. And then the cool thing about doing it this way, if you've got a proper stock option plan in place, is you can have vesting on it. So if they say they're going to do all this amazing stuff, you can say, okay, great, let's put some vesting on that. And that can be time-based. So every month or every quarter, you can catch up with your advisor, and you don't want it to be like negative thing. It's a positive thing. Hey, how did we go this month? How did we go this quarter? Are we adding value? Okay, great. You know, and if they're not, you can say, okay, well, look, we need to stop this advisory role now. The company's grown a lot. We actually need a different advisor. And then it's a nice mechanism for putting that equity back in the pool, grabbing yourself a new advisor, perhaps. And then, you know, for whatever stage you're at, because companies move very fast and the advisor you need in year one might be totally different to the advisor you need in year two, for example. So
I just want to chime in really quick with respect to that FAST agreement. So it's great if you have no idea what you want to grant, but just keep in mind that is not the actual award agreement. I've had so many clients come to me and they're like, oh, I awarded this, but in that agreement, it specifically states that it'll be awarded pursuant to a separate award agreement. So although it acts as like this kind of like the services agreement and setting forth what type of equity you will be granted, it's still subject to board approval. It's still subject to actually awarding it via a separate agreement. So just make sure that you're into account. So
I'm so glad you said that, because what I wanted to add was in the Cake app, there is a standardized like agreement that the board or the shareholders can sign to implement the scheme. There's a standardized stock option plan. There's a standardized like offer that you would send. And, you know, we work with the wonderful, you know, Maya Law to be able to help you edit those things. So, you know, it's really important that you work with these standards as much as you can. Make sure you get the right documents signed, get the, you know, the legal support where you need it, but get all the documents in place in the right order, because then you might get to your Series A and your investors are going to say, hang on a sec, you've got a stock option plan. It's not actually implemented. Your offer letters aren't signed. Like, what the hell's going on here? And you know, things can unravel pretty quickly. Maybe we can finish this stock option or plan section by just asking Cash and John, like, you know, how do you see, or what are the best benefits you see of having a stock option plan in place? And then maybe what's one or two of the biggest issues you see as investors, you know, when looking at a company and a cap table, and perhaps seeing a few issues around it as well.
You want to go first, John?
Go,
Sure.
John.
Yeah, in terms of the option, in terms of the biggest issues that we see is either people running through their options pretty quickly, or not deploying them fast enough, or not using them to the fullest extent possible. Again, a lot of it is, and some of the big issues that we see is with documentation as well, with earlier stage companies. To Melody's point, these things require a lot of procedure. So again, board consents, in documentation that needs to be that needs to be done prior to any of the grants, even if they're RSAs or employee options. Those needs to be done, and also understanding how the structure impacts like LLCs. Obviously, because of the different tax treatment, you might have an immediate tax liability if you do something like that for employees as well. Even having 409A evaluations in place before giving those options also gives a better clarity on what those entail for their employees. So in terms of mistakes, what we've seen is people kind of underutilizing them is one of the biggest mistakes that we've seen with the startups. They hold on to it for a long time. So between funds, we see a lot of carryover options moving between stages. So for seed stage companies, the best way to do this is having a solid plan for hiring and the talent that you need, and also allocating those options in a way that you utilize them, and also making sure that you're not underutilizing the options that you have to attract talent.
Yeah, to his point, that's where I wanted to talk about a little bit is, how do you think about utilizing those stock options to get the best ROI? So as an entrepreneur, you go through this thought process when raising outside capital. I'm going to sell 15 or 20% of my company for X amount of dollars, and I, over 2 years, want to turn that into X amount of value for my company, whether that's in the form of revenue and then getting through those other things, or there's maybe another mechanism between that where that's product that's going to unlock future value or valuation or whatever else. And It's helpful sometimes to sit down when you're looking at a candidate to say, what is the impact this candidate's going to have on the business? And what is my budget, both with cash and equity for this role based on the amount of value I'm expecting to get out of it over the next 2 to 4 years during the vesting schedule. And I've seen smart entrepreneurs go through that analysis and say, this role is going to hopefully increase, maybe it's going to double my revenue because this person, I have confidence that they'll be able to sell, or maybe there's a tech hire that will help me unlock new customers because we'll be able to ship certain features that'll increase revenue. And then they create a couple options. They say, if they want higher cash, then I'll give them less equity. And if they want less cash for more equity, then I can give that and kind of negotiate that way with those hires, but thinking of it in terms of an ROI perspective, the same way you would with outside investor capital.
Absolutely love that. I think what we've uncovered there is there's two big components to getting this right. There's the whole technical risk and compliance and legal element, which if you don't get it right, you have a lack of trust, you have, financial risk, you have compliance risk, and then there's the people component as well. And I guess the ROI component, which is when I implement the scheme, I need to make it help me attract better people, engage them better, retain them. And I think that there's wonderful mechanisms built in to the system, like, the cliff. You have a 12-month cliff, so no one gets any for the first year. You have a 3 or 4 year vesting period. And as the company goes up in value, the 3rd or 4th year, the amount of equity people can be earning can be really material. And that's a great way to retain your team through those periods. And a lot of the IP in those early stages is in those people. So I think, and then talking through that, making sure your team is aware, like imagine the difference between a team member who knows what they're earning. Hey, you're earning 50 grand a year this year in options, and next year you could be earning 100 grand a year in options, versus someone that just isn't really aware, doesn't even know if they've signed their thing or what it's worth, or like just think about the engagement and retention difference between a properly implemented and communicated equity plan and with the right culture versus not. So we've only got a few questions left. There's something I'm mega passionate about. I could talk about that for a long time, of course, and I really appreciate all your insights. I think we hit the nail on the head with that one there, and we've actually answered some questions along the way, so thanks for that. I've got a really quick one here. I don't know who wants to cover this. If an investor has most favored nation terms, are they ever open to negotiating that if you have another offer at terms better than theirs? Maybe we can just have a really quick answer on that one.
My answer would be everything's negotiable. So, I mean, you don't get what you don't ask for. So if something comes up where you need to go back to your investor and say, listen, I know we entered into this term, but here's my situation. I find that most investors are fairly flexible and they want to see the company do well. And if you're entering into an arrangement that's going to help propel the company, that's only going to benefit them too. Of course, there are certain investors who won't want to budge based on the terms that they signed. And then you figure out workarounds. But I definitely think that you just have a conversation and go back to the investor and explain what's going on.
Awesome.
I will also
All right,
add,
well, I
be
think-
careful. Safe notes often don't have favored nation clauses, but it's still good practice to go back and talk to those investors. Again, just keeping your allies on your side is always wise.
Nice. Look, I think we've answered all of the questions. There's one there on licensing. I think it's better to hold your IP in a different entity than your trading entity. I think that's pretty clear. That's not legal advice. I'm just going to do that one quickly from my old accounting days. Yeah, I think there's a question there from Michael about how much to allocate to the different roles like C-suite and seed round. So I'm going to follow up with some information, and we're going to finish with this. Just where to get the best resources, because capital raising and employee equity, it's a massive field. It takes years to become an expert, and you need the best resources, you need the best support, which is why I've put this panel together, why we're here today. Now, Cake has created an equity toolkit. It's got a ton of what we tried to do is bring all the best things we could find from around the internet, around equity plans and capital raising to help you hack through and simplify things. We've, of course, got the Cake app, which simplifies and streamlines a lot of things. Please do check that out. Everybody here, I think, is open on LinkedIn to connecting around these topics. So please do reach out to us. Does anyone have one or two or one resource that they want to highlight before we go? The recording will be shared to everyone, as well as this equity toolkit, so you can access this and the toolkit, which has other webinars and stuff in it. Anyone else want to add anything on the resource side of things before we wrap up?
Sure, we have a founders corner on our website. So to the extent that you need additional information, want to request a roadmap, if you don't know what you need from a legal perspective leading up to a funding round, just feel free to reach out and we're happy to kind of direct you. And, you know, even if you need a due diligence list to figure out what legal ducks you need to get in a row, happy to provide that type of information.
Amazing. And Cash, you've got a toolkit too, yeah? At Sweater?
Yes, any startup that reaches out to Sweater to establish a relationship or seek funding, whether we invest or not, we share this toolkit with them. So if you're interested in it, feel free to either download our app and submit your pitch deck there, or send a LinkedIn message to me.
Awesome. We'll run out of time. Look, I think that was ultra valuable. I just love hearing from experts on these topics. It's very complex and costly to run rounds and look after your equity. And it's one of the most important things that startups and founders need to do. So thank you so much to the panelists. Thanks for joining. We really hope that we helped you, and we're all here to help further. So hit us up on LinkedIn, and yeah, good luck scaling your companies.
Thanks for having us.
Thanks for having us. Bye.
Bye.